A massive overhaul of the U.S. tax code is right around the corner, and trust me, it's going to affect pretty much everyone. So, over the next few minutes, we're going to break down exactly what these changes mean for you.
You know, when you see changes this big, there's really only one question that matters. How is this going to hit your wallet, your savings, and your financial future?
So, where's all this coming from? Well, it's a new piece of legislation called the One Big Beautiful Bill Act, or OBBA for short. This is the law that's literally rewriting the rules for 2026 and well beyond.
In this explainer, we're going to cut right through all the confusing legal language and give you a clear, simple guide to the parts that actually matter most. No jargon, I promise, just the essentials.
Okay, first up, let's talk about your personal tax situation. The new law brings some really significant updates for individuals and families, especially when it comes to saving for the future.
So, starting in 2026, you're going to be able to put more away for retirement. The 401k contribution limit is jumping up by $1,000 to $24,500, while IRA limits get a nice $500 boost. This is a direct chance for you to really accelerate your savings in a tax-advantaged way.
And for anyone who is 50 or over, this number is just huge. You can now put away up to $32,500 in your 401k. Think about it. That's the new 24/5 base limit, plus the increased $8,000 catch-up contribution. It's an absolutely powerful tool to beef up your savings as you get closer to retirement.
The law also locks in a few other changes. That fix for the marriage penalty, that weird quirk where some married couples paid more in taxes just for being married, that's permanent now. The child tax credit is staying put at $2,200, and there's still a $500 credit for other dependents. But, and this is a big one, most of those miscellaneous itemized deductions, things like unreimbursed employee expenses, are gone for good.
Okay, so let's switch gears and look at what this all means for businesses. The OBBBA introduces some major shifts designed to really encourage investment and growth.
Now this is a game changer. It's a complete reversal on what's called bonus depreciation. This is a tax break that lets businesses deduct the full cost of new equipment right away. It was being phased out, but the new law brings the 100% deduction back and makes it permanent. That is a massive incentive for businesses to invest, right now.
And here's another huge win, this time for innovation. We're talking about R&D costs. Before, companies had to spread these costs out over 5 years. Now, they can go back to deducting those expenses immediately, in the same year. That frees up a ton of cash flow and really encourages more investment in research.
The law also gives a pretty significant boost to the tax credit for employers who help their workers with childcare. The general credit jumps from 25% all the way up to 40% of eligible costs. And for small businesses, it's even better, a full 50% credit. Plus, the maximum credit amount has been raised substantially, too.
And on top of all that, a few other key provisions are now permanent. This includes that 20% deduction for qualified business income, for pass-through entities, and higher limits on deducting business interest. The cap for Section 179 expensing, which is another great tool for small businesses to write off equipment, that's also been increased. All right, finally, let's zoom in on what this all means for your investment strategy. The new law really solidifies some key rules that, honestly, every investor should know.
First, just a quick reminder of a timeless rule, the wash sale rule. This isn't new, but man, is it always relevant. It basically stops you from selling a stock at a loss just to get a tax deduction, only to turn around and buy it right back. If you do that, the IRS makes you defer that loss, so you can't claim it right away.
A core principle of investment tax strategy is still very much in play, the difference between short-term and long-term gains. Gains on stuff you've held for less than a year get taxed as ordinary income, but long-term gains, they get a much lower, much friendlier rate. Simply holding on to an investment for more than a year can make a huge difference to your final tax bill.
And looking a little further down the road, the OBBA makes the Qualified Opportunity Zone program permanent. This program lets you defer and maybe even reduce taxes on capital gains if you reinvest them into special development funds. It's really an incentive designed to get long-term investment into communities that need it most.
Okay, we have covered a lot of ground. So what does this all mean for you right now? Let's just boil it all down to your next steps.
The most important thing is to be proactive here. First, take a hard look at your saving strategy and see if you can max out those higher retirement limits. Second, if you've got a business, it's time to reevaluate your investment plans to take advantage of the new depreciation and R&D rules. And finally, you've got to stay informed because tax law is never, ever static. At the end of the day, these changes are creating brand new pathways for saving and investing. So the big question we'll leave you with is this. Now that you know what's coming, how are you going to get prepared to make the absolute most of it? Thanks for tuning in.